Good morning friends, myself Dinesh from Fundamental Research. I will be discussing the market outlook. So starting with the domestic economy, the inflation has declined to under 7%, whereas the core inflation has declined to about 4.1%, which shows moderation in the inflation fears. Moreover, the bond yields have also declined to about 7.9% compared to 8.1% a couple of months back. That shows the kind of decline in the interest rate scenario also. However, the GDP growth of 4.5% in the month of for the third quarter was slightly disappointing. But the economic survey expects GDP growth to range to about 6.1 to 6.7% for FY14, driven by strong policy measures and also due to monetary easing by RBI. The improvement in the global environment would also support GDP growth in FY14. Now, coming to the Union budget has failed to enthuse the markets compared to heightened expectations and the state of the economy. There were expectation of big bank reforms which could not happen in the budget. Rather, it created a bit of confusion in the mind of foreign investors by tinkering with certain tax relief for foreign investors. But on positive side, there were few things which were taken well by rating agencies. For example, in the budget, the fiscal deficit targets have been lowered to 4.8% for FY14, which was well taken by credit rating agencies and RBI. So we believe going ahead, RBI would reduce the rates by about 25 basis point in the coming monetary policy review. The RBI will derive comfort from some moderation in the inflation and also a sharp slowdown in the economic growth. Coming to the corporate earnings, the corporate earnings for Q3 were largely disappointing, as the revenue growth has declined to about in a single digits, driven by slowdown in the economy. The earning growths were also lower than the estimates, whereas it was slightly better in the preceding quarter. Therefore, the slower growth in earnings led to increase in the downgrades during the Q3. Going ahead, we believe that given the sluggish growth in the economy, the pickup in the earnings will happen in a gradual manner. We believe the fiscal measures, the pace of monetary easing and the fiscal measures announced by the government would be key to earning upgrades going ahead. Now, looking at the global scenario, the sequestering at the US and conclusive elections in the Italy led to some kind of deterrence in the global markets. Also, the tightening measures taken by the China to control the real estate prices also created kind of disappointment in the global economy. However, we believe that from India's perspective, the inflows will remain strong due to strong global liquidity, unless any catastrophic event happens, which seems unlikely. So we remain a constructive view on the Indian equity markets. The Indian equities have underperformed in the recent month compared to its peers due to several reasons, such as weak global environment, domestic challenges faced by the economy, also due to budget related some disappointments, and also sharp decline in the mid-cap prices, which weakened the sentiments. Going ahead, we believe the equity markets will get over the budget-related hiccups and will track fundamentals. We maintain our constructive view on equity markets in view of the cyclical turn expected in FY14, aided by the fiscal measures taken by the government and further monetary easing by RBI, and also a benign global environment. Thank you.